Hi, all. Welcome to Internet Capital's first in what we hope to be a long line of interviews with founders and other important people in the crypto industry. We're very fortunate today to have Justin Bebis, the CEO of Conclave, with us. Justin's been in Ethernet security for since 2020 for 4 years. Freelance developer to a CEO, so I think that means a bootstrapper, which I like. Uh, his technology and his work has secured several billion in assets under management. And he's basically grown from an advisor to a developer to a CEO. So, Justin, thank you for being here with us today.
Thanks for the intro.
Yeah.
Yeah, thanks Justin for being here. We really appreciate it. If you wanted to kick it off, the Grand Santo, with some questions, I actually had a quick question just for you, Justin. I'm wondering like how you got into crypto in the first place, like what attracted you to the space, and how did Byte Masons and then eventually Conclave get started?
Yeah. I was at like a business analyst job at a health tech company in Chicago. That, I kind of got promoted into the role, and I was, just like yes, 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 and kind of got into a position where I was doing like a really boring job. It's like once in a while it would be fun. Um, and I had before that founded a cafe, and I really loved growing the business and being like really active in the community. And it got to a point at this BA job where I was like, all right, I need to find a new career. So at the time, I had been getting interested in finance. My job, I was adjacent to the finance department, and I was helping a lot reconcile, or rather investigate, like a really bad audit where there was like a $155,000 hole, and I was like doing weeks of work just spending time on this one mistake that took seconds. And obviously, like I was doing tons of Googling, and literally the finance department didn't have anybody that could, do stuff as fast as me or as effective as me. So I was just saddled with it. It wasn't my job. And I did kind of like it. And all of the kind of Googling, the Google algorithm got lined up with my interests and served me an article about Bitcoin as a ledger or a triple entry accounting solution. And I started reading about it, and I was like, okay, the idea of party, counterparty, and then universal third party, and the idea of this shared ledger was frankly really exciting. And thinking more and more about it, I was like, wow, there's something to this. And I had been aware of Bitcoin since its inception almost. I was into like RuneScape, which is very like crypto adjacent. I was doing all sorts of like I was like making businesses out there. I was like going crazy, and I'd always thought, it's a Ponzi scheme, it's a scam, which maybe it is a little bit. I didn't know enough about finance to really, think about it in a more nuanced way. And from there, I was like, all right, I'll make this my career. And I started doing some research. I found out about DeFi. I found out about, after DeFi, the Phantom Network, because of its connections to Andre Cronje. I put my life savings into the FTM token in 2020, and it went pretty well from there. And I founded Byte Masons in late 2020. I was like, oh, this can be my career pretty easily. I started teaching people about Ethereum security. I started teaching people about smart contract engineering, because I had been like really diving in, learning for like 6 months at that point. Um, and from there, it's like, hey, we're a study group. Hey, we're a freelance development group. Hey, now we're founding our own app. And it just like went there, it just got bigger and bigger. And, I guess at the peak, in our own apps, we were managing 350 mil. Our kind of DevSecOps advisory sort of operation, we were helping secure, upwards of $8 billion. A lot of that on the Phantom Network. And, we we were hyped, and I'll tell you, I was definitely more of a developer than a leader at that point. Obviously there are some innate leadership skills that come with, being able to talk and maybe be a little charismatic, but certainly I wasn't the greatest CEO in retrospect. And so, when Luna crashed, we basically saw all of our yield products lose PMF. All of our clients, basically went kaput. Spending went down to zero, investment went down to zero. So we sat down. We were like, okay, we have this big pile of money that we earned from grinding through 2021. What are we going to do? And we decided that we love DeFi so much, we were going to figure it out. And then we basically took all that money. Everybody, we had to do a little bit of a headcount reduction. Everybody took a pay cut. But we carried 20 people, mostly engineers, through the bear market with the intention to build the best DeFi software in the world. And I would say at this point, in a lot of ways, we've already achieved this. And I think our real magnum opus is on the horizon now, building awesome lending and CDP platforms. And, along the way, we built Radiant Capital V2. Now we're doing this insane consulting deal that I'm not allowed to talk about quite yet, but our research is getting validated. We're working with the best teams in the industry, and our love is still community building, and our love is still making DeFi the tool set for retail finance. And what you see, for example, on IronClad Finance or Aurelius Finance is us basically taking this unselfish approach where we're like, hey, Foundation, Mantle, or Mode, or Optimism, whoever, here are the issues we see with your network. Here's how we can use a protocol and a go-to-market strategy to resolve them. Work with us, help us grow, help us build this community, and we'll have 2 people, working full-time on it, plus a team of more, working on security, developing technology. And, the pitch is basically, we can give you a middle market protocol with all the hallmarks of an upper market protocol, being, we don't need to be $1 billion. We just need to serve most people as well as we possibly can. And yeah, I think, we're obviously continuously iterating and learning and trying to understand this concept, breaking new ground. But so far, it's been great, and that's where we are. I think we promised no long introductions, Mr. Tonto, but I figure that gives you a good snapshot.
No, that's great. And one thing that I noticed immediately, it seems to me that Conclave, your organization, is a bit, well, first off, it is bootstrapped, but it's also non-traditional in the sense of how you create apps. You're a legit company that has employees, that has a research side. And I want to say, you don't know how much it pleased me when you forwarded me that research paper and it looked like it was formatted with LaTeX, and reading that. So that I like that. But you have that core research, but you also have these products. And I guess a question I have is, how do you balance, personnel, finance, time with a consumer, or at least a customer facing side and a researcher side?
Yeah, it's really hard, and I'll tell you, in the bear market, we slimmed. We had done a lot of research. We locked in on, okay, here's the spec, here's the implementation. So we slimmed way down on research in the bear market because, obviously that's kind of the first thing that goes. And so, we're implementing these systems, and, then who is now our head of DeFi and was at that time a contributor to our governance, UV, says that, hey, he might be willing to work for us. And this guy is chartered mechanical engineer, elite, mechanism design is his bread and butter for high value at risk systems. He's developing missiles and weapon systems and whatnot. And believe it or not, between aerospace and DeFi, there's a lot of correlation. Between physics and DeFi, there's a lot of overlap in terms of mechanism design and mathematics. As with everything, all math is 1 degree apart. So, we onboard him and we're like, hey, we need someone to manage DeFi at the product level. Like we want to win. We have, for the longest time been super engineering focused. Like we want to create the best, most scalable, but also like simplest and most secure systems. And now he's coming in, and what he's doing is he's taking these systems we've designed, which are flexible, frankly amazing, and he's applying some of his mechanism design skill set to ensure that we can be the best. So I know that's not really an answer to your question, but in terms of balancing all of these goings on, it's really hard. It's like you can only when we kind of operate like a co-op at the Conclave level. It's not like Justin Bebis gets all the upside. It's really like we want the smartest people in the world working for us, and we're going to give you the most incentive possible. And so it's really like, hey, UV, you have this sincere interest. You've been writing about DeFi forever. You have this insane, like 1 in 100 million skill set. Just do it. And we need to hire for people. When you say just do it, it gets done, because when you're wearing so many hats and spinning so many plates, there needs to be a ton of intrinsic motivation. There needs to be a ton of entrepreneurship, and that's really what we hire for. It's like motivation, entrepreneurship, and the rest obviously doesn't take care of itself. But our job becomes, let's make the best systems for them to thrive within, and then I don't need to like go down and into the trenches and micromanage. And so we've been very blessed to have an absolutely amazing team of people who would probably be building if they weren't getting paid at all. I think that's how we're able to outperform. It's how we're able to move fast, and it's how we're able to get a lot of work done.
Yeah, I just think crypto attracts polymaths, generalists, enthusiasts just by the
Yeah.
nature of the technology in the space. So it's awesome to hear that reflected in your organization and your protocols, because I think that's what makes the best product at the end of the day, not VC money, not any of these other factors, and that's the most important thing. So just wanted to throw that in.
Yeah, definitely. I think we, we started off, we hate VCs. Bear market hits, we're like, oh God, we need VCs. And now we've kind of found the middle road where it's like, okay, the right VCs can really level up a project. But otherwise, we build around that. It's like we want to onboard users, we want to onboard real people, and we just need to be smart enough on the business end to figure out how to monetize at these smaller scales, which I think we do a really, really great job of. And our systems at $10 million of TVL can produce more cash flow than systems with $100 million of TVL. And that's really just a testament to our ability to optimize and iterate on these designs.
So that kind of is a good segue into building something from the ground up. And, I first got to know about you and your projects through IronClad. I'm not so much interested in the technology at this point behind IronClad, but can you talk a little bit about the process? Was it your idea that you took to Mode Network? Did Mode come to you? Was it something else?
Yeah, so, we have relationships with 30 blockchain networks, and we have, I would say, probably the most robust kind of business intelligence database of information about these networks. And priorities are obviously always like shifting and evolving as new programs are created, new hires are made on their end. And I think with Mode, it's funny, like we have this database, it came totally out of left field. And a group of our LPs, like there's a growing collective, honestly, of people who only deposit in either Aave or like Morpho or our protocol, which is hilarious because it's like, multi-billion dollar, $10 million, and there are a lot of whales that really trust us. And a group of them DM'd me and were like, hey, here's Mode. They're doing a really like high ROI, short-term airdrop. We want to allocate $10 million to this. There's not a platform on the network that we trust. Will you come? And from there we were like, all right, we'll figure it out. So, I hit up, I see, Redacted Cartel on the Mode website. I hit up Sammy. I'm like, dude, set me up with their founders so I can figure out if this is possible. I talked to James, I talked to Jake, I talked to Adam and the rest of their team. And, we very quickly realized that they're serious and they're actual DeFi users. So we're like, okay, this is cool. Things looking good. And we essentially decide that, we're going to lock in and just do it. And it kind of hopped ahead of a lot of the existing plans we had, simply because it was a very short-term exciting opportunity. And from the point of that initial DM to us launching the full IronClad protocol was maybe a period of 2 weeks. And this is just kind of a testament to our ability to scale. It's like, people look at a lending protocol, for example, and they're like, oh, it's just maybe you forked Aave, maybe you forked Compound, maybe you did this, that, the other. But, the amount of work that goes into the DevOps and the maintenance and the monitoring and the deployment, it's like, okay, sure, there may be a lending system here, but the code that backs it is 10 times larger in scope, and even in maybe not necessarily in workload to create, because it's a lot of TypeScript and a lot of Forge and Foundry, but certainly in terms of sheer volume and sheer mass, it's enormous. We have our own liquidators, which was an immediate massive edge. So yeah, we move really fast. We deploy. People start entering the protocol. It's like, whoa, now we're up to over 100 million market size. And, conversations get much easier at that scale. So we can kind of, okay, let's get in on the OKX program. Let's talk to these LPs. Let's maybe secure some long-term stakeholders in the private market. And now, we're at a point where IronClad, as a lending platform, Mode has reinforced their decision that Ionic, they want to be kind of the premier lending platform. Which is fine. And so, what we decided is that we're going to implement IUSD. We're going to debut our new autonomous money supply control system for Mode. And Mode has this really serious problem of supply of assets like ETH and USD. They have so many LRTs, so much Bitcoin, so much demand to borrow, so much demand for leverage, but not enough supply. So here we have what is technically an infinitely scalable system that we can accept deposits of LRTs, BTC, interest-bearing assets for, and immediately solve that problem. So now the question is, okay, how do we scale liquidity for this stablecoin, and how do we show Mode that, hey, if you go in on this with us and you work with us to build up liquidity for IUSD, you now have a distinct edge. And it's kind of an easy conversation when, I would say our research is industry leading in terms of this kind of mechanism design being peg stability and PID control. And so, yeah, that's where we're at. And it's really just we see opportunity, we seize opportunity, and this specific opportunity was so flash in the pan that we moved fast, and we're honestly excited about the future of Mode. We're builders, so we like when the price is low, because that means we can build, and once people start getting excited, we'll have the best protocol on the platform, period.
I was going to ask about your thoughts on the Optimism superchain generally, because that's actually how I found my way to Mode in the first place. It's because it's an Optimism affiliated network, OP superchain. Shout out the permissionless fault proofs just launched this week. Optimism's doing great work. Power user, Optimism's my home base, so I was like, I'll try it out. Are you, I guess, kind of partial to the Optimism superchain's kind of design model and that generally, first? And then second, I wanted you to get a little deeper on IUSD, just kind of comparing it to maybe for beginning users to Aave's Go stablecoin, or how a user would mint DAI through a CDP. Just kind of give the differences there.
Yeah. So number one, What was the first question? I got the second question.
Basically, just are you bullish on the
Oh, the
Optimus
super chain.
chain and why? Yeah.
Yeah, I mean, we're super bullish on it. We've been working with the Optimism team forever. Right now we're like doing a lot of big time consulting work with them. We've built a lot of trust, and I think, architecturally, it makes so much sense. Like they're the team focused on horizontal expansion at the chain level. We're the team focused on horizontal expansion at the application level. So the alignment there makes a ton of sense. I guess I would caveat to a certain extent that, like, in terms of like technical advantages here or there, really what we're more interested in is like what users want. It's like in the same way there have been 1,000 or 1,000,000 or endless amazing books that have been written but never read. It's the same thing with tech. It's like there have been millions of lines of code, millions of systems, whatever, of great performant, amazing technology that have just never gotten adoption. And I think Optimism kind of treads a solid balance between, hey, here's the adoption, and hey, here's also the tech. And they're never, I think, like with the horizontal growth expansion in terms of like pure single focus performance, they're never going to be number one. But in terms of scalability, I can't see anybody beating them, horizontally at least. So obviously, it aligns really well. We really love it. Really love working with their team. We've been doing a lot of teaching in the background of their team about DeFi, because it is not a DeFi native. Optimism isn't DeFi native. Base isn't DeFi native. Mode is DeFi native, and Fractal is DeFi native. But we're trying to get people understanding, like, hey, the value of your block space is going to be directly correlated to the value of your DeFi ecosystem, and they're learning. So, further to that, talking about like how you can think about IUSD versus an Aave or a Maker. Aave and Maker, I think the biggest difference are governance driven. Ignoring like the system that mints the CDP, I think there's something to be said about all the different mechanisms that go into it. But really, what we find is the biggest driver of success is adaptability. And especially in this world where, Ethena, the basis trade, type stable coins can print 20, 30, 40% APR. The teams that can react fastest and best are going to be able to compete with that. And, Maker and Aave are very governance driven. And Go has had a very hard time scaling because of that. Dai has, I think they're so lindy and they're so big at this point that they don't really need to care. But in long time frames, these governance controlled systems are going to fail. Maybe not fully fail, but they're going to be less competitive overall. And so what IUSD has is it has a PID control system. And a PID control system is just a way to take information in and make a decision algorithmically and execute a change. It's essentially a way to govern a system algorithmically. And so, what we can do is we can look at, how much has been minted, how much is being minted over a certain time period, what's the demand right now, what's the fluctuation there. So we can take all that information in on one side, and then on the other side, we can look at the core LP, the stable swap pool, and the system can say, okay, what is the weighting in this pool? And not looking at the peg, because you could be 99 cents and be like 30-70 weighted toward the counter asset or toward your asset, which basically means you're seconds away from being off peg. So we look at the liquidity weighting, and we can update interest rates depending on that weighting. And for a PID, you set like a control point, like what do you want to target? And so we target a perfect 50-50 weighting. And as people buy and sell the stable coin, interest rates are updated algorithmically to react to that. So essentially, you have a system where if everybody is shorting the stable coin and selling the stable coin, our system can see that in real time and react in real time. And what's really important about that is you become invulnerable to carry trading and someone minting your stablecoin to sell it and go buy SUSDE to earn, their 20%. If that's happening, then our system will adapt and increase interest rates. And based on this, based on our ability to perfectly track user behavior, which Ethena does to a certain extent as well, tracking like interest rates on the supply and the demand side, we're able to essentially do the same thing, but generally we'll be charging less interest than competitors, simply because this mechanism is in place that deters certain actions. So obviously, like a free lunch, sometimes a free lunch is a great way to scale. It's like, oh, hey, here's the easy arb, let's get a bunch of supply into the market. But there's always going to be the contraction at the other end of that. So in terms of realistically organically scaling the protocol, there will be nothing better than our money supply system. It's kind of like Curve USD, but a little more. Curve USD looks at price, whereas we look at the weighting in the pool.
So talking about that, two things. First, how do you simulate your algorithm? You must have built up a very good model of the crypto environment and users to be able to simulate these things, tune these parameters.
Yeah. So we have an insane amount of data. Like we have a whole set of real-time data infrastructure. We have a whole set of nice persistence infrastructure using blockchain ETL. It's also vectorized, so we can explore it with AI. But really what it comes down to a lot of times is our head of quant, Toli, and you can check out his blog on Medium at Toli Data. Depending on the chain, because not every chain supports Dune, it's like he has 100 tools. We just whip him until he has a nice solid data set. And then him and our head of DeFi comb through everything and do a bunch of back testing and do a bunch of modeling based on that. And we do a lot of this somewhat in the public. So if you check out our research papers and you check out the blog of our head of DeFi and the blog of our head of quant, they detail a lot of these methodologies, and we're really big fans of modified Sortino ratios. We're really big fans of kind of taking things like used in TradFi like Black-Scholes and Sharps and Sortinos and kind of fitting them to the use case. So obviously with Sortino, you'd look at downside volatility, you'd measure it against opportunity cost, and come up with some perceived ROI. But you can do the same thing or something similar with, for example, liquidity depth, or fit that to returns on a liquidation, or fit that to some other kind of DeFi thing. And then you have a really nice predictable system where you can take something that's really battle tested, and we do the same thing for risk management. It's like we can use it for quant, we can use these popular equations and algorithms for risk management, we can use them for treasury management, and a lot of the math, we mentioned this at the beginning, is there's so much overlap. Like Black-Scholes, that's something you'd see in a physics textbook. It's like if you look at AMMs, some of them, again, you'll see in a physics textbook, you'll see in game design, like noise maps, things like that. And so we try to get really creative with how we apply these battle-tested formula to DeFi, and we write a ton about it. So definitely check out our blogs. And I think really once you get a really good handle on these heuristics, it's like I literally I'll be using Sortino ratios in my head to calculate what I want for lunch. Okay, the opportunity cost is what we have at home. What's the price here? How much am I going to enjoy it? What are the calories? All right. So there's just a certain drilling in on these time-tested formula. They just come in handy. It's like the Sharp and the Sortino. It's just the ultimate way to assess risk and opportunity cost. And you just look at something sometimes and you're thinking about it from the risk manager's perspective.
That's awesome. I love all of the proprietary, or I call it proprietary, novel stuff you're doing. Obviously, crypto is an, I guess I'll say, open source preferred type of community.
Yeah.
The things you're doing could have real value to your organization if they're not open sourced. How do you balance that? How do you handle that?
Yeah, we think of it kind of like give and take. So, you know, we think a lot about our contributions to the public domain and the public knowledge pool. We do a lot of stuff that's open source. We do some stuff that's business licensed. And we're even thinking now to start scrapping the business license and focusing more on open source. And, you know, it's really like, what are, it's like, take a penny, leave a penny. Like if we're using Aave v2, then if we're modifying it, we're going to be doing it under the purview of AGPL3. We're not going to try to find a workaround. We're not going to try to do like a clean room rewrite, and we're going to be happy about it. And you know, for our research, for example, like we want people to adopt it. You know, you can't copyright an equation. Obviously, you can copyright your specific implementation, and you know, it might be hard to fork your software or whatever. But the thing is, like, talent is so right now, especially scarce in DeFi, and it's obviously relative depending on, you know, demand, but there's just not enough talent out there. And even if we were to put everything like on a pedestal and give everybody our deployment scripts, everybody our monitoring infrastructure, everybody, you know, everything, it's like nobody would do it anyway. You know, the only time we're forking something is exciting is when people are chasing beta. Like, for example, when Velodrome launched, it's like everybody who missed the boat, they're like, oh, you know, I want my own, you know, day one Velodrome investment. And then that's kind of how crypto works, where it's like, okay, you've got the top dog. Here's the guy that forked it. They're going to compete. Maybe they'll do something one day. But our mindset is really, you know, I think if you incentivize the best talent and incentivize the best work, then you just don't need to care that much about keeping things closed. It's just honestly sometimes more convenient to keep it closed so that you don't have to manicure a code base for public consumption. But we're very collaborative, and we love giving people access to our research, and we're big fans of OSS.
Awesome. So I want to kind of switch subjects here just a little bit. So this was sort of interesting to me. Last night yesterday in the Avix interview, you said the real way to get revenue is by staking, which implies some long-term users. Kind of coincidentally, Brian Pellegrino from Layer Zero last night said they are looking for, quote, the most durable users. So it seems like there's this, at least somewhat of a trend to not rewarding everybody, but find people that will be there to support the protocol going forward. And that's that's the human nature side of this. My specific question, though, gets to the actual staking side of things. And I mentioned this to you before, but one of the first ways I got interested in what you were doing was looking at the Reliquary and Relics and how those operate. So if you could you kind of describe the thought process that went from going from liquidity mining, Master Chef contract through VE tokenomics and got you to Reliquary and Relics?
Yeah, yeah, totally. I mean, we started off in yield ag, which is basically like you need to master every protocol. You need to figure out where the incentives come from, how they get there, and how you can capitalize on them. And so Master Chef in 2021 was like what everybody was using to emit incentives. And you know, really, it stunk. And, you know, there's infinite writing you can read about why it stunk and how it stunk, so I'm not going to get that deep into it. But, you know, on the other end of things, so it stinks for the protocol, Master Chef. It's like you're giving away these free tokens, it's over, goodbye. But on the other end of the equation was VE tokenomics, especially with the recent curve liquidations. We thought this absolutely sucks for users. And so you have the teams doing VE that are like, hey, we're just going to extract as much value from the end user as possible. And then you have on the other end MasterChef, where it's like it incentivizes users to extract as much from the protocol as possible. And so, we've been thinking really hard about this for a long time, and what we ended up on was a system wherein, like, it has similar mechanics to MasterChef in that, hey, you deposit, you get some amount of incentives. There's a lot of flexibility and a lot of wiggle room, but really what we've done, and this was very, very tricky to engineer, believe it or not, because dealing with these incentive curves, the numbers can get wacky, and the errors can get wacky with weird behaviors or edge cases. But we developed a system whereby the longer you are in the staking pool, the higher your weight will be when the system actually emits assets. And this had been done in the past. I mean, we were the first to build and open source a system like this. Like, I think we open sourced it in like late 2021 or early 2022. But like, there were a handful of people that built it the easy way, where it was like, hey, we're just going to make this number go up, and the results were really bad. So what we're able to do with Reliquary is we're able to basically program a really nice curve, and we're able to weight every user individually. So it's not just a function of, hey, your time in the system, but it's a function of your time in the system, the given curve for that pool, everybody else's time in the system. It's a system that's aware of context within a given pool. So really what that means to the end user is, if you are in that pool for a long time, it will be harder to dilute you. And the only way to dilute you is by someone with significant commitment coming on board. And this, aligned really well with our vision for like making the best kind of tool for retail DeFi users. And I think, when you give a trader upside, when you give a trader some ROI or some multiple, the best traders are going to realize it. They're going to sell. And it makes sense. Like, why would they not? The incentive is right there. But when the ROI is yield, and we don't care about price, we just care about how much yield is being delivered to the end user. What we found when we built Radiant V2 is that users operating in size would literally buy the Radiant token, write it down to 0 just for the extra yield. Because if you have to pay 5% of your principal to get 15% APR, then a lot of people will just do it. And if the token stays level over that period, then you've outperformed. And we try to take this a little further by giving these weighting mechanics. So the day one hardcore users have really high incentives to stick around. We wrap the positions in an NFT so users can capture the premium on the aftermarket. So if you're like a 2x weighted position, you've been in there for a year and you need liquidity, you don't need to withdraw and dump. You can capture that premium based on your time in the pool. And we just think it's a better system. And our goal is to, obviously we want a lot of upside in every capacity, but really like this idea that, the best DeFi protocol, and you look at Velodrome, you look at Aerodrome, you look at Ramses, all these kind of hyper-optimized flywheel sort of protocols, you look at market cap, it goes up, 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 but price stays the same. And every single person that locked in their VE Velo or whatever over that period has made an absolute killing because the price was able to stay level while all of this yield, hundreds of percents a year, was delivered to the end user. And we feel pretty strongly that locking is not really the way, except in kind of niche circumstances, unless you want your users to write the value of the token down to 0, which sometimes is really good. So we've created a system whereby it's fully liquid. There's a reason to have the token. You don't need to write it down to 0, but also its main function is delivering real yield. And Reliquary is the driver behind that. And we just feel that for DeFi, and this is why DeFi is a little harder to participate in, because you need to understand that this is for long-term people who want long-term yield. But it's basically like, you don't have to fully write down the token, plus you get this yield, and we can theoretically, outperform it with the delta between PA and yield. And even in like really not great case scenarios, using O tokens, which if you don't know what O tokens are, look up Tapioca and read some of their blog posts. I'm not going to drill in. But using O tokens, for example, we can also give people that entered kind of early, we can de-risk them super fast. Because then it's like, hey, you took this risk here, we're going to be inflating, but every little bit of inflation is going to be tied with another chunk of yield. And then it's like the people who founded the protocol with us, the people who staked day one, just receive maximum benefit. And obviously from that point, it's like sales. It's like, okay, can we get other people to commit? How can we kind of give them the upside that they're looking for? And very complicated balancing all these stakeholders potentially, but I think our system will be good, if not great.
Awesome. So we've talked about IronClad. We've talked about Relics and Reliquary, and I look at both of those as things in your toolbox. You have a lending protocol, you have this very cool staking system, but those are really part of your big vision, which is Codex.
Yeah.
And I think your words were it's the unified DeFi ecosystem, which I absolutely love. Targeting retail investors.
Yeah.
That's a giant opportunity, and it's really hard.
Yeah.
Can you give everybody maybe the elevator pitch on what Codex is?
Yeah. So Codex is the DeFi discovery layer. It is going to be the best non-custodial app for participating in DeFi, and it's going to be the absolute best place for someone that is not using DeFi yet to start their DeFi journey. And it's also going to be the best place for the experienced user to optimize their performance. Obviously, it takes a lot to do that. And the amount of technology we've built these past 4 years, it would take me maybe 5 hours to break it all down. But I would say we're firmly positioned as a market leader in intense AI-powered interfaces, even data. We've just got so much data, so many ways to package it, and so many ways to use it to give users an edge.
So I love that, and I want to dig in a little bit on the AI side of things. So
Sure.
I was a little worried at first when I read about this that there was going to be AI also deeply embedded on the back end. It seems like it's mostly embedded on the front end, the agentic interface, that sort of thing.
Yeah.
The question I have on that part of the AI, though, is, have you done a sensitivity analysis? How do you know, because these are going to be retail, non-crypto native users, how do you really understand what they're saying, and simply a simple misinterpretation changes what you put together for them based on what they want?
Yeah, totally. I mean, that's the biggest concern, and it's also the reason blockchain is so important in the growth of AI. So, I'll put it to you simply. We use AI to interpret what the user says, as you stated, and we don't depend on AI to make too many decisions or build too many transactions yet. The goal is to create a generalized system where that's possible, but AI just isn't ready. So in the event of misinterpretation, really, there are a couple scenarios. One, the AI just can't find a match in the database because we're not going to support behaviors that would result in some terrible outcome. And the second big thing is this idea of the intent. So using AI to interpret an intent, there's declarative intents, there's imperative intents. An imperative intent is, I want you to do exactly this. And that's really easy because it's oh, this user knows what they want, we can take them there. Now, the declarative intents, that's where things get tricky, and that's where margins of error or margins for error can become really difficult to navigate. And we have a handful of ways that we do this. So way number one is, okay, so if it's a little bit unclear, we can do a couple things. Something that we really like is Duolingo's sentence builder. If you've ever used Duolingo, they have a system whereby you can build a sentence and you'll think you're freaking fluent in German, even though if you were thrown into the mix, you would have no idea what you're talking about. So depending on the user's level of expertise, using kind of a guided sentence building structure where it's like, okay, we're not really going to give them room for gross error. We may give the system a little bit of room for like, oh, maybe the output is USDC instead of DAI, or maybe the output is an LRT instead of ETH. And we're not really going to allow that. Like, we'll stop that transaction. But what's important here is forming the valid intent. So extracting the information from the user such that we know that what they're saying is good enough. And now where smart contracts come into play and why smart contracts are most important is if you have an intent, you can intuit an ideal outcome. So if the user is trying to create a complicated position in DeFi, and we can intuit what they're trying to do, then we can generally say, okay, if the value of the output, if the dollar value of the output tokens is significantly less than the dollar value of the input tokens, and Uniswap has been doing this with slippage controls for years, then we know for a fact that we need to revert the transaction. So it's essentially a matter of, we build the transaction, we bundle the transaction, we send the transaction off, and it's literally we pass along with it an assertion that the transaction meets some requirement at the time it's complete. And smart contracts are awesome because we can use a bundle, delegate, and require sort of pattern where once we delegate the transaction, we can require that the user's wallet has what we expect it to have or revert the whole thing. And then the question is like, okay, like what is going to be the error rate for users? What might be frustrating? Because if we're kicking back 40% of transactions, it's like people aren't going to use Codex. So what we're thinking to start out while we really kind of train these systems and get the UX to where we need to be is really just giving users options. So if the user expresses a declarative intent, we interpret it. We can say, okay, we think this is a 90% match, this is a 75% match, this is a 50% match, and present those three options to users. And those options we can validate concretely, like, okay, those are good routes. We know that will accomplish what the user is trying to accomplish roughly. And then the user kind of takes the puck or takes the ball from us and makes the decision and does their swipe to confirm. So that's generally how we're thinking about it. It's like, you're kind of describing the most difficult problem, which is also the most exciting problem to solve. And the reason, like, people are like, oh, blockchain for, data, whatever, like making data open or training these things or creating, open source training systems, which we think is like, okay, sure. Docker Swarm has solved decentralized AI already, but obviously incentives are really powerful, and that's where a lot of this stuff comes into play. But we feel that the real saving grace of blockchain AI is in the determinism of blockchain as the antithesis to the probabilism of AI. And you combine them, and now you have a system that can make its own decisions with the safety net being we're actually going to fully revert that transaction because we have access to the entire chain of state changes, and we have the ability to throw an assertion at the end. So as these blockchain systems get more performant, you can send bigger messages, bigger transactions. Eventually an e-commerce site can operate fully on a blockchain, and you can track a transaction chain from the user visiting the site all the way to them making a purchase. And there is the ability to fully revert because blockchains are designed to do that. And that's super exciting to me. I think that's like, we lucked out. We have a staff level AI engineer who's like a 20x monster working on a lot of our AI stuff. And we just hired a new ML AI engineer. We've got another AI engineer on staff, and all these people are like, our staff level AI engineer, we've kind of like trained him to be crypto native because he's super ML AI native. But these other two are super crypto native. One is also a smart contract engineer and an app developer, super psycho. So yeah, we just like we have what we need to execute, and it's really a matter of keeping users safe and figuring out how to evolve with that being the top priority.
So I love that. I love that on the AI side. So that's like the current hot thing. But I think the back end of this system is old school computer science in the terms of how you build sequences of transactions. Is there a graph? How do you add new transaction types? Can you talk a little bit about that part of it?
Yeah. We're using retrieval augmented generation right now to really nail the interpretation of the intent, and add to the prompt where needed, flesh out the prompt where needed, and I would say probably where we're looking right now, and there could be 1,000 directions, frankly, that we end up going as far as optimization goes. But it's almost like a pathfinding algorithm, and creating kind of this graph of like decision making. It's really like the system will get more and more precise every layer that we add, or the more we kind of expand the graph upward. And then it's like, you have the intent up here. Here's like intent layer number one, or I mean, frankly, a lot of our friends in AI have found that layering multiple models is more effective than fine tuning. So it may literally be, okay, here's 7B or 10B number one. That's just like interpreting one aspect of what they're saying. 7B number two, here's interpreting one aspect of what they're saying. Here's the prompt injection based on those interpretation. Here we rag something out. Here we, actually build the transaction. Here we validate the transaction. And obviously all of this is happening at computer speed. But that's where we think things are headed right now. It's literally like layer by layer by layer. How can we like build this like system of data? And we like not like depending too much on AI. Like we like using AI as sort of a matching engine and a pathfinder, as opposed to necessarily a decision maker. But obviously, every VC, everybody wants the universal AI, like ultimate decision machine. So it's kind of balancing, like, how can we maintain the pie in the sky vision architecturally? How can we keep that path open to us while also, like, we're product guys. Like, we want to ship a good ass product. We don't want to be in the ivory tower, taking Adderall all day or whatever they do. And so that's kind of how we're building. It's like the reconciliation of what the market wants in 10 years and what we think we can deliver now.
Gotcha. Last question on this. So I think I understand how you build the transaction. Do you have the ability then to simulate it before you send it out for execution so that you have a kind of a reasonable clue it's going to work?
Oh, yeah. Yeah, totally. Like transaction simulation, luckily there's so many awesome open source libraries for static analysis of transactions. I think where the issue comes in is once it hits the chain and is in kind of the MEV arena, and people can front run, back run, exploit, whatever, you need to have that hardline guarantee at the smart contract level. Like you can do analysis out the wazoo, but a single sandwich attack can change the entire context of what you're doing. Like with flash loans and everything, it's like you just need to be extra careful. And so a lot of that will move on chain. And I think that's where we will totally excel beyond anybody is like we're smart contract guys. Like all these teams like building out intents, it's like, okay, you can get 75, 80, 90% of the way there if you're really good at AI ML. But the only way you're going to build a perfect system is if you're really good at building out smart contracts. And I don't see a team right now that has the breadth of our expertise, nor the depth, really. The reason that we talk to investors about Codex is like, okay, distribution. What's the plan? How are we gonna get help on that? Obviously, you can read about how to distribute product 1,000 different ways, but it takes like experience to know how to scale to an insane level. And we lucked out in 2021. It's like billions of dollars. It's like right place, right time. People liked our authenticity, but the market has matured a lot since then.
So is a potential outcome for this, talking about distribution, Morgan Stanley uses Codex as they white label your product, and that's what they give to their retail investors if they want to get into crypto.
100%.
Wow.
Yeah. It's really like we think of Codex as the ultimate demonstration of the tech, but talk about like Franklin Templeton, BlackRock, Hamilton Lane. They're all working in the tokenization space at scale. And here we have a system that can navigate CCIP. All of them are thinking about fragmentation. We can, like, we're already, with Securitize, Hashnode, et cetera, all these RWA providers we have relationships with. There is a world where Codex is a tool for tokenization. There's a world where Codex is a tool for navigating all sorts of market verticals. And we build everything cloud agnostic. We build as much stuff in like C++ as possible, so that it can plug kind of into the TradFi universe. And the goal is like, we want to build good stuff. And if Morgan Stanley wants to give us $1 billion for it a decade from now, they can.
Good. Well, we have used up our hour. I wanted to just open the floor to you if you wanted to share anything, any alpha. If not, I wanted to thank you. This has been, for me personally, great learning experience. So thank you very much for that. But the floor is yours now.
Yeah, totally. I mean, I think IronClad on Mode is the big focus right now in terms of launching the ICL token, validating a lot of the technology. So highly recommend giving that a try. This summer, I guess the alpha will be we're designing and managing a huge incentive campaign all across the superchain, and we're going to be helping grow DeFi as a whole, which is really exciting for us. And I think Codex, like cod3x.org, Codex with a 3, we'll eventually get the CODEX domain. I tried to negotiate it from the guy that owns it, and he said his wife wouldn't let him sell it. So it is what it is. But yeah, like, get plugged in. I'll tell you, like, this is a token that doesn't need emissions. And so our number one thing is user acquisition. And so if you're just a user, you don't need to be a billionaire, a gazillionaire. If you like DeFi, get involved early, and it's going to be very rewarding. And we want to get you locked in, and we want to give you the best tools that we can.
Awesome. Ben, do you have anything else?
No, that was fantastic. My one takeaway that I would say from my perspective is that you guys, Justin, your whole team, Conclave, is really focused on the user experience, the best mechanism design on the back end to the actual experience using DeFi on the front end and everything in between. And I think that's my biggest takeaway. And it sounds like you guys are doing awesome work. So keep it up. Really admire the work you're doing.
Yeah.
Hell yeah. Thanks a lot. And great podcast. Really great questions, Mr. Tonto.
Thank you. And thanks for taking a chance on us. Appreciate it.
Oh, hell yeah. Oh, I've got all the time in the world. You're so awesome in our Discord. Thanks for all the effort there. It really, like, I always rotate through the Discords, and then IronClad, I see you in there. I'm like, okay, it's good. We've got the positivity. So
well, I appreciate that.
Thanks
Thank
a
you.
lot. Yeah, appreciate the energy there.